Welcome to the Microstructure Exchange. Today we have Mao Yi presenting a paper that is titled Market Structure and Corporate Payout Policy. And this is joint work with Xiongshi Li and Miles Zheng. Mao, the screen is yours.
Okay, thank you very much to give me the opportunity to present this paper, Market Structure and Corporate Payout Policy. So in this presentation, I want to convince you like market structure frictions can explain two famous puzzles in the corporate payout literature. So we know there are two forms of corporate payouts, dividends and share repurchases. So Miller and Modiani said paying out through dividends or share repurchases does not matter. And later people discovered the tax disadvantage of dividends. So dividend tax was higher than capital gain tax, and also capital gain tax can be deferred. So if we combine the MM and the tax disadvantage, that raises two fundamental puzzles in corporate payout literature. The first one is called dividend puzzle. So Fisher-Black just asked, why do firms pay dividend at all? Because share repurchases are cheaper because they have tax advantage. And you can find some answers to this puzzle. For example, widespread answer for the dividend puzzle is like for some reason people like dividend. For example, people have some issues on self-discipline. So if you give them dividends, that helps them to do self-discipline. But later there's another puzzle which is called circular increase of share repurchases relative to dividends. So basically, share repurchases increase relative to dividend consistently over the past 3 decades. So in this paper, we try to provide a consistent and unified interpretation for these two results based on the costs of share repurchases. So market structure frictions can explain why share repurchases cannot completely drive out dividends because they are market structure frictions. And the reduction in share repurchase frictions over time explains the circular increase in share repurchases. So what are the costs of share repurchases? So we're doing research on market microstructure. One common answer is like liquidity cost. Definitely firms and their investors need to pay transaction costs in share repurchases. So in this paper, because we only have 45 minutes, I want to emphasize another cost, which is a compliance cost. So what is the compliance cost? So SEC Rule 10b-18 is a rule to regulate share repurchases. So there's one thing SEC Rule 10b-18 say is like repurchase price should not exceed the high-risk bid price or the previous trade price. So why? So this rule, the philosophy of 10b-18 is prevent firms from inflating their stock price by aggressively demand liquidity at the ask price. So this rule, 10b-18, basically say, okay, if you do share repurchases, you are issuer, a firm, you should provide liquidity to the market at the bid, or the price should not be higher than the previous trade price. So how big is the friction? Let's think about that. Think about a traditional market microstructure model in a dealer's market, either inventory model by hold and store, or information asymmetry model by Glossing and Milgren. You will realize the friction actually are surprisingly large. Why? Because in these models, firms cannot buy at the bid price because buy orders are executed at the ask price. And firms cannot buy at a price less or equal to the previous price because a buy order tends to push the price up. So in dealers market, actually, it's very hard to do share repurchases. And the move toward electronic limit order books and dark pools actually reduce these frictions. So in limit order books, share repurchases becomes relatively easy because firms can submit limit orders at the bid price. And for dark pools, firms can match their orders passively at the bid price. So if we go into more details, the design of the limit order book also matters. It depends on the execution priority. Suppose at the same bid price, it also depends on the tick size, which is the minimum price variation. For example, in 1994 Manning's rule. So before, it's very important. Why? Because before 1994, NASDAQ dealers can trade ahead of issuers at the same price. Although in New York Stock Exchange, this is different. Okay, so for example, in NASDAQ, suppose a dealer quote a $100 bid and a $102 ask. And if you are issuer, you are firm, you also quote a $100 bid. You try to do share buybacks. And you have lower execution priority as the issuer. The issuer's quote actually only entitled to an execution when the market ask price dropped to $100. So there's an issue before the mining rule. Number one is like there's high execution cost for issuers because of they have lower execution priority. And also buying at ask actually violate SEC 10b-18 because the execution is at the ask. What does mining rule do? Mining rule prohibits dealer from executing ahead of their customer at the same price, basically give higher execution priority to the issuer or the firms. So we find here repurchases of NASDAQ firms increased by 69% relative to non-NASDAQ firms. And also tick size matters. So tick size used to be very wide. It's 1/8 of a dollar. So it reduced to 1/16 of a dollar and then to 1 cent in 2001. What does tick size do? Tick size basically reduces the depth or the queue to provide liquidity at the same price. And we find like share repurchases increased by 68% for 1997 sample, and it increased by 32% in 2001 sample. And also there's a difference between manual share repurchases and automatic share repurchases. So in this one, we have a unique shock, which is coming from like a Hendershot, Mankiewicz, and Jones. It's like New York Stock Exchange installed auto quotes in 2003. So the computer algorithms now can automatically execute share repurchases. So this reduces both execution and compliance costs. So we find New York Stock Exchange firms increase their share repurchases by 24% relative to non-NYSE firms. Definitely, there might be some confounding effect in this event studies, and we find a unique control experiment which partially reversed all these market microstructure changes in 2016. So in 2016, SEC randomly select 1,200 stocks and increase their tick size, the minimum price variation from 1 cent to 5 cents. And the tick size for 1,199 control stocks remain at 1 cent. We find the repurchase payouts for treatment firms decreased by 21%. And the reduction is as high as 45% if the stocks bid-ask spread are less than 5 cents before the treatment. We call these firms tick-constrained firms because the increase in the tick size creates a binding constraint of their bid-ask spread. And a unique feature about this experiment is like there are also 400 stocks in test group 3 suffer from additional treatment, which is called Trade Act requirement. So what does Trade Act requirement do? So basically it says that dark pools needs to execute a trade at a price 2.5 cents higher than the high risk displayed bid price. So the basic idea of that is to give execution priority to displayed orders. So at the same price, Trade Act rule grants execution priority to displayed orders in the exchanges. So definitely with some exemptions for the dark pools, but in general, basically it's like if a dark pool wants to execute an order, the price should be 2.5 cents higher than the high-risk independent bid. So how big is the friction? This friction actually is surprisingly large for firms. Why? Because when firms try to buy back shares, they also subject to 10b-18. So the repurchase price by 10b-18 should be less or equal to high risk displayed bid price. So think about it. The Trade Act rule says you should buy back in a dark pool at a price of 2.5 cents higher than the independent bid. And 10b-18 says that you should buy at a price lower or equal to the independent bid price. So these two rules actually unintentionally contradicts with each other. So the unintended contradiction between these two rules implicitly ban share repurchases in dark pools. So we find tick-constrained firms in test group 3 reduce their share repurchases by 55%. And tick-constrained firms in test group 1 and 2 reduce share repurchases by 33%. So this is the introduction of our paper. So before I move on, do you have any questions?
We do have a question. Thanks,
Yeah.
Mao, for these impressive numbers. There's a question from Michael Goldstein about the relevance about this beyond the US. So he's writing, dividends exist in other countries with stock markets, but do these countries have SEC 10b-18? If not, why would this be so important?
Internationally, we start to look at that, but we are, I know in some countries, like in Germany and Japan, there's even more stringent requirements. And in some other countries, there's less relevant. So there's a huge variation across different countries. I know US is not the most constrained, neither the least constrained. Actually, it's something typical. My answer to Mike actually is like, we try to address two famous puzzles in payout literature. Majority of these studies actually is using US data. So the first step, I agree with you, like international study is important, but the first step is to address why this happened to the US. And the next step is like, we should go to other countries to study. For example, it's like a circular increase in share repurchase relative to dividend. Does that hold in other countries based on different market microstructure frictions? But that's a great feedback. Yeah, thank you.
Maybe related, Marcus Carrera has a question whether this is controlled by differences in tax regimes.
Yes, actually. We actually address the, not regimes across internationally, but we control for tax within US, actually. In our event study, actually, we actually able to address the most fundamental puzzle in tax literature in corporate payout. So it's like, it's written by Charty and Sayers. They actually find that something dramatic happens. It's like after dividend tax reduced, dividend should increase more relative to repurchase, right? But they find the opposite. We find market structure frictions actually can explain why there's a reduction in dividend tax, but an increase here repurchase even more than the dividend. Yes, we control for a tax regime, and we actually, that's one of the reasons to motivate our study. Thank you, that's a great comment.
Okay, I have two more questions and then we can move on. So this one is from Pankaj Jain.
Yep.
How much flexibility do firms have about announcing and not implementing repurchases?
That's a good question. There's lots of flexibility. Actually, in our paper, we find it's like the tick size pilot, actually, the impact mostly through the implementation of share repurchases. Basically, the pilot and the control firms, you cannot find a statistical difference in their announced share repurchases because this is many of them announced before. But tick size pilot is a market structure friction. It harms the implementation of share repurchases. So lots of firms actually announce share repurchases, but they cannot get that complete on time. So that also tells us it's like there's a flexibility of firms to execute their repurchases. So the effect is mainly market structure. It's like a firm announce similar share repurchases, but the pilot group, after market structure reduced, maybe their broker tells them something, so they have dramatically less complete rate of share repurchases.
Good. So one final question before we continue is from Andreas Park.
Yeah.
Are you implicitly asserting that repurchases happen at the ask, meaning they don't use passive orders? And do increased tick sizes make repurchases with passive orders more attractive?
Yes and no. Let me address the second part. Yes. It makes share repurchase more attractive in one sense. That means like if you provide a liquidity, you probably have a higher rent, but you need to compete with other guys who also try to capture the rent. So conditional on your order is able to field, actually increase the tick size, making execution at the bid actually better. But the main story of our paper actually is like, for example, if firm try to do share repurchase, one competitor for them now actually is high frequency traders, but they face even bigger competition before, because many years ago they actually competed with the dealer. It's more profitable if you submit a limit order to execute. But the question is that you face other people who try to execute for a living. They try to capture the bid-ask spread. That actually, the answer to Andrew's question is like, okay, yes, conditional you can get executed. Increasing tick size is better. And conditional on, but it doesn't reduce your fill rate. Yeah.
Thank you. So let's continue.
Okay, so first let's start with the controlled experiment, which is the tick size pilot. So the tick size pilot, we provide, let me give you some brief overview. So it starts with the universe of regulation NMS securities in April 4th, 2016. So it focuses on small and medium cap stocks, market cap smaller than 3 billion, price higher than $2 on the last day of measurement period. Price is greater than $1.5 every day, average daily volume smaller than 1 million shares during the measurement period. So the result is 2,399 stocks. So then it end up with these stocks, and then I believe and then the SEC or FINRA create a stratified random sample of 27 markets, 3 by 3 by 3 independent sorting based on share price, market cap, and trading volume. And in each group, they are low, medium, and high, and each has 1/3 of the population. So the final list is 1,200 treatment stocks and 1,199 control stocks. So there are 4 groups. In the control group, the quote rule, you can quote in 1 cent, you can trade in 1 cent, and there's no trade rule. So the test group 1, the number of stocks is 400. So you can quoting 5 cents, okay, but you can trade in 1 cent, and there's no trade rule. So test group 2, also 400 stocks. So you can only quote in 5 cents, you can only trade in 5 cents, and there's no trade rule. So finally, the most aggressive treatment is test group 3. So you can only quote in 5 cents, trade in 5 cents, and there's a trade rule. So what is the roadmap of our presentation? We compare the aggregate effect. We compare 3 test groups with the control group to evaluate the overall impact. And then we compare the test group 3 and test group 1 and 2 to evaluate the impact of dark trading. So let me see. So methodology is nothing fancy. It's a difference in different tests. So YIT is payout of variables. And we have firm fixed effect, we have year quarter fixed effect, and treatment is equal to 1 if a firm is in the test group, and 0 if it is in the control group. And in this test, both equal to 1 for quarters in the pilot period, and 0 for quarters 2 years before the pilot period. And the control variables, we control size, profitability, and growth opportunities. So in the appendix, in our appendix, we also control other things like option issuing, anything in the literature, occasionally think of anything can affect the payouts. So let me show you the first result. So this is the aggregated result. We find firms share repurchase decrease by 0.09% over the total assets per quarter. This is over total assets. This is a big number because the average repurchase payout before the pilot was 0.43% of total assets per quarter. So that means firms reduce share repurchase payouts by 21%. And the dividend does not change as much, okay? So that means actually firms' total payouts, because the total payouts is share repurchase plus the dividend, the total payouts decreased by 14%. And the payout structure, what is payout structure is an important variable, which means share repurchase payouts plus 1 divided by dividend payouts by plus 1 decreased by 0.08, okay. And here is the result for tick constrained versus unconstrained groups. Again, tick constrained means like your tick size is fine, okay, at 5 cents before the treatment. We see the impact is much bigger. Constrained firms in treatment group reduce repurchase payouts by 0.18%. The average share repurchase payout before the pilot was 0.41%. That's a reduction of 45% compared with pre-shock level. But this raises a puzzle. I remember I had a discussion with Ingrid Warner, and we had a deep discussion and make me more conservative, think a long time about our result. It's like, usually if we don't get results, we are panic. But this one is so big. And we know the tick size pilot, the maximum impact probably is like 5 cents. And if firms still pay, firms can still pay repurchase by paying a few more cents per share if they can use market orders. So that catches becomes like notice 10b-18. So it's not easy for them to buy at the ask, because 10b-18 think buy at the ask is possibly one way to manipulate the share price. So they impose like 4 safe harbor conditions. So that means like one of them is share repurchase price should not be higher than the highest independent bid or previous trade price. So basically they want firms either to provide the liquidity to the market. That's one way to understand, or they're trading up passive. Okay, but then interestingly, so this rule actually combined with share repurchase will have some interesting implications. So let's look at a $5 stock here. So we have 2 types of guys. It goes back to Andres Park's question. It's like, so there's a rabbit, let's call them high frequency traders. And there's a turtle, let's say it's a broker of issuers. But first thing we think about, why high frequency traders are slower than a repurchase broker. And one day we actually have the idea, we actually visited Citadel just for this question. They give us a great answer. They said, yes, so, as the farthest trader, we also think about whether we can represent firms in their share repurchases. They actually even try, but finally realize if a firm hires Citadel as a broker, Citadel becomes slower because they need to change their computer programs to comply with 10b-18. Even at a few lines in their computer algorithms, that slows them down. So then, even if you're a rabbit with 10b-18, you become a turtle. So what does 10b-18 do? 10b-18 say, okay, can firm like use market order? With some exemptions, you can always find a way, but generally, issuers repurchasing at a price exceeds the highest bid are subject to manipulation suspicion. So that means technically you cannot do that. So then, like, what should firm do? Firm should say, okay, easy way is like I join the queue. For this example, it's like they're rabbit here. If firm queue after several high frequency traders, so let's say, or other people who happen to be on top of the queue, firms can buy at a price which is not higher than independent bid. But what this is 10b-18. But what does tick size pilot do? Tick size pilot basically removes this pricing grid. And then that may generate the queue to provide liquidity. You can see like there are probably some like other traders here providing liquidity, but all of them are forced to join the same queue, probably because it's more profitable, and the repurchase broker actually have lower executing priority. So in this case, if they get executed, this is good news to them, but they compete with other guys at the same queue. So that's also actually bad news for them. Okay, so that means like how to test that? The way to test that is to look at the queue on the bid side. So here we have the result. So we find increasing depth harms share repurchases, but the effect is much larger on the bid side. For example, we can partition firm into 2 groups. So firms with large increasing in the R side depth, okay. And we find there's no difference in result if we partition firms based on the R side depth, okay. But for the bid size depth, the result just goes the opposite way to our original intuition. So generally, we think it's like a large depth is good for liquidity, but in this case, we find if there's a large increase in depth, actually firms reduce their share repurchase much more. Actually, here I remember in the paper there's a number. They reduce their share repurchase by 55%. So so the summary is like a great depth is generally considered more liquid. However, a market with large depth on the bid side may imply an illiquid market for issuers. So that means the definition for liquidity can be different for different types of traders. So then let's do another thing. it's like let's compare test group 1 and 2 to test group 3. We find test group 3 subject to dark pool treatment. Okay, we find tick-constrained firms in test group 3 reduce share repurchases by 55%. And tick-constrained firms in test group 1 and 2 reduce share repurchases by only 36%. Originally, this result is also like surprise us because like Rindy and Ingram Warner has a paper. They show there's a modest difference in changing liquidity, and we reconfirm their results. But here comes the question: is like why a small change in liquidity leads such a dramatic increase, change in share repurchases? To find it again, we need to go back to the compliance channel. So what does dark pool do? Dark pool matches orders passively using price of other of other exchanges. So suppose there's a long queue here, okay, lots of rabbits, and actually a turtle can do something we call it's queue jumping. If you go, so you do the queue jumping. Basically, is that the turtle actually can go to the dark pool and get execution priority. But the new trade act rule for test group 3 basically say, okay, try to improve the trade transparency. That's it. Orders in dark pool has to improve the price in stock exchange by more than 2.5 cents. So what does that mean? That means, okay, if dark pool with some exemptions, there are always some exemptions, so I will not go to the detail. The dark pool need to execute the orders at a price which is higher than independent bid. But 10b-18 said you should be lower or equal to the independent bid or last transacting price. So basically, there's some kind of implicit contradiction between these two rules that harms share repurchases, because the repurchase brokers now face double constraint in both exchanges and dark pools. So that means they fail to execute. So we believe that's one of the reasons why the share repurchases in the tick size pilot group 3 firms reduce their share repurchase by a lot. So so let me summarize that. So here's the main intuition. It's like to combine. It's like a market structure and some other research. It's like the tick size is a small friction, but it follows literature about non-price competition under price controls. So this year, actually I was visiting Harvard this year. I have several conversations with like Xiongshi Schreifer. It's like it's interesting. Like our research with his research overlapping one dimension is like so basically like Corney and Schreifer and Vishny write a series of papers showing if you constrain price competition, that generates two things. First one is queuing. Basically, what they show is like in Soviet Union, it's like their results show 25% of people's time spending on queuing to get some bread, whatever. And what is queuing? Queuing means like arrive at the market earlier to beat the rivals. So in this sense, high frequency trading is something looks similar. And there's another side, we have relatively little evidence. We don't directly, but it looks similar. It's like so if you control the price, the other thing is called dark market or side payments. I believe we don't have a result. It's just some conjecture. It's like the dark pool might be an application because dark pool is not free. Think about it. Firms can pay the dark pool to find trading counterparties, and the dark pool then can pay for order flow to the counterparties. Then there's a buy and a sell matching here. Okay. So this is the main intuition. So, and let me then point out some limitation of the pilot. It's like this focus on small and medium-sized stocks. So is that a small firm effect? Within our sample, the best thing we can do is partition these results based on total assets. So we have like above medium firm, below medium firm in terms of like total assets. So we find for small firms, tick-constrained firms reduce share repurchase by 46%. And for relatively large firms, or like in general, they are medium firms, tick-constrained firms reduce share repurchase by 45%. So they are similar. Okay. And finally, we have one more year of data. We can do the reverse test. So the tick size pilot ends on October 1st, 2018. We find tick-constrained firms increase their share repurchases after pilot ends, and it's 45% increase in share repurchases. So any question before we move to the event studies?
There are plenty of questions, Mao. And the most popular one is from Albert Menkveld. And you have presented a lot of evidence, but Albert wants a smoking gun. He asks if you have any anecdotal evidence that a company's CFO explicitly mentions market structure or change in market structure when motivating a share repurchase.
That's a great question. Yes, we actually call a bunch of CEO and CFO, but you probably you probably ask why I know CEO and CFOs, because I was on Cornell board of trustees, and there are plenty of CEO and CFOs on the board, on Cornell board. The answer is yes. Actually, the answer is perfect. They told me it's like they learn market structure in a hard way. It's like because many of them graduated from like business schools, they don't actually incorporate market structure in their business education. So they learn market structure matters the first time they have been hit. For example, like a tick size pilot, it's like I talk with the firm said, if I know this pilot is not something which just I pay a few cents, it's like it's a huge constraint. They actually dramatically underestimate the market structure frictions. And we can talk about later. And lots of CFO and CEOs tells me it's like even flash crash matters for them because some of their contract or whatever is benched on extreme price. So the main takeaway actually is like I talk with my colleagues in other fields. It's like market structure is important. We should definitely incorporate market structure in business education. Yes. So let me summarize. It's like the answer to your question is yes and no. They probably don't know much when they are not hit by market microstructure shock. So they learn that in a hard way. Once they have been hit by market microstructure shock, so the learning curve is steep, and then they know a lot. Yeah.
Cool. So the next question is from Evangelos Benos. He wonders if you can give a rough estimate of the economic cost associated with the repurchase before versus after one of these events that you study.
That's a great question. I think it's like the rough estimate. There are two ways. First one is like some firms have unfinished share repurchases. I think actually that's a bigger cost. And if you look at the transaction cost, that becomes a little bit more tricky because I know Chen Yao has a paper recently published in GFE showing it's like there's a cost to firms' value. But then it's very hard to disentangle our channel with their channel. But I think we can estimate how much firm need to wait after the tick size pilot to complete their share repurchase program. That part we can do that. And for transaction costs, we believe there is also some. But the question is like how to disentangle our effects with the effect originally discovered by Chen Yao and Rio Albuquerque and their co-authors. Yeah.
There's another question on the economic magnitudes by Andreas Park. What's the size of the repurchase program relative to ADV, relative to depths, and for how long do these programs run? And there are more questions here, so hang on. Also, can't the broker make an announcement about matching prices, etc.? That should allow them to attract volume from public markets. Or completely differently, are firms maybe poorly advised?
I think firms are poorly advised. Like each firm should hire a market microstructure expert in this kind of things. This part and the volume part. Andreas Parker asked a great question. Actually, that's a deep question because originally we thought the constraint is volume constraint. Because there's another constraint. It's like you cannot buy more than like 25% the average daily volume. But that part actually was not that binding because now volume is huge. I mean, you don't need a very large volume. So volume is much less a constraint. And also goes back to Andrea's question, this share repurchase program lasts very long. It can be several years. So they still have time. So volume is less a constraint. It's like if you just wait for volume, buyer able to repurchase. But if it's based on price, that becomes much more complex. Because today you compete with other guys. Tomorrow you see these guys again. They try to provide liquidity. But these are great questions. Yeah.
Let's take one more and then continue, perhaps. So this one is from Michael Goldstein about the detail about this rule with the last price.
Yeah.
Is the last price for the same exchange or across all exchanges? Because if it's across all exchanges, he wonders how you could possibly comply with that if markets are trading very fast, like in microseconds or milliseconds.
Michael, that's a great question. Actually, that's a great point. That's the last question, by the way, right? Right?
There are more questions, but I think we'll stop here. And
okay. Mike, actually, that's a great point to move to the next section about the control experiment. So actually, the algorithm trading, actually, now I cannot say it's necessary, but it's very important to do the compliance because the market moves so fast. So that's the reason we find the effect of the move from manual to electronic trading actually dramatically increase share repurchase. I believe one of the channels mentioned by Mike is like compliance becomes much easier. Okay. So now let's look at the event studies. So the first one is the 1994 Manning rule. So that increased the executing priority of NASDAQ issuers. Okay. So this has a dramatic change by share repurchase by 69%. So remember, it's like a tick size pilot show longer queue harms share repurchases. So because issuers may not win time priority over professional liquidity providers. But I don't want my paper interpreted as a result of high frequency trader harm share repurchases because it depends on your benchmark. If you compare with markets like 25, 26 years ago, market makers, especially in NASDAQ, they enjoy much more priority. So before the Manning rule, a NASDAQ dealer can trade ahead of their customer, even if their customer submits the order earlier. So basically, NASDAQ dealer can only need to like execute their customer orders when it crosses the ask. So before that, actually, Manning rule, I believe NASDAQ is more of a dealer market. So the Manning rule prohibited dealers from trading before the customers at the same price and makes it easy for issuers to execute their limit orders at the bid price. So here the treatment is NASDAQ firms versus matched non-NASDAQ firms. The post is 1995 and the pre is 1993. So there are a little bit caveats here because we know in the same period, we also have the old A's, but fortunately, both move to the same direction, okay, in terms of market structure change. So here we find the NASDAQ firms relative to other firms, repurchase payouts increased by 69%. So this is annually, so it's 0.42 per year relative to their original amount. So this is a dramatic change, okay. So, and then how about the tick size reductions? So the reduction in the previous result, reduction Q length at the same price should increase your repurchase because that reduces the competition at the same price. We find the reduction Q length in the same price increase repurchase by 68% after 1997 and 32% after 2001. Okay, so we know it's like a tick size decrease from 1/8 to 1/16. So the treatment group is the firms with above median reduction in the quality spread. And the control groups is firm with below median reduction quality spread because in this one, we don't have a natural like a control and pilot group. So we compare that with 1998 with 1996. So and then we also study decimalization. Okay, so here is the result. So we find 1997 tick size reduction, repurchase payouts increased by 68%. So 2001 decimalization repurchase payout increased by 32%. Okay, so finally it goes back to address Mike Goldstein's question and also the fundamental puzzle in tax literature. So I think at the beginning there's a question about the regime tax change, and there are people doing the research on tax change. For example, this is a QJE paper by Rod Charlie and says. So they find actually dividend tax cut. Their main result is dividend increase Sure, we know that. But their paper has a one solved puzzle. It's like repurchase payouts increase even more relative to share repurchase. That's very, very puzzling. So a reduction in dividend tax should increase dividend relative to share repurchases because there's a reduction in tax. So tax advantage of share repurchases actually reduce. So Rothschild paper does not provide an answer. But they leave a comment saying understanding the microeconomic foundations of the cost of share repurchases is of great importance for future work. And then there's no follow-up paper. And we provide maybe the only, but the first interpretation is like, okay, there are lots of market structure changes. And I think one of them is done by like Albert Mankiewicz, your paper about auto quotes. So before 2003, specialists in New York Stock Exchange manually disseminated quotes. So then because of that, I mean, share repurchase is more manually. We call several like brokers, so they call that high touch approach before the auto quote. So that means you need to work around the floor to see who are interested, buy a little bit here, buy a little bit there, minimize transaction costs, and also comply with 10b-18, which is really hard. And auto quotes allow computer programs to execute share purchases, which is low touch. And it gives real-time feedback to market information, and also you can automatically submit orders. And our control group now here is non-NYSE firms. Most of them are NASDAQ because I had a conversation with Terry Henderson. So my understanding is like, and also with some other people, it's like NASDAQ actually moved to electronic before that. So now it's a treatment group is New York Stock Exchange firms versus matched non-NYSE firms. So we find repurchase payouts of New York Stock Exchange firms increased by 24%. So finally, let me conclude our paper. So I try to convince you stock market structure has first order effects on share repurchase. It's not only the transaction cost, the bid-ask spread, it's also the cost to comply with SEC 10b-18 is prohibitively high in a pure dealer market. So, but think about it. I showed lots of events and also lots of market structure changes. Think about that. So, market structure reform. So what do we do? I think there's a general trend. It's like since 1990s, reduce the privileges of professional market makers, providing liquidity more democratic. No matter whether it's a tick size reduction or reduction in execution priority of dealers. And this trend of disintermediation reduce the frictions for issuers to buy back shares, because in this process, they also effectively provide liquidity to the market. And the cost of repurchase provides a unified explanation for two puzzles. The reduction in the liquidity and compliance cost over time can explain why share repurchases increase more than dividends. However, this liquidity and compliance costs always exist. That provides the explanation why share repurchase cannot completely drive out dividends. And I also want to mention the two new dimensions for research on liquidity. So usually we consider liquidity in general, but I think our paper raised two questions. The first one is liquidity for whom? Because regulations can change the definition of liquidity for distinct group of traders, because each group of traders, they have different constraints. For example, a market with a great depth is generally considered liquid, but it might be illiquid for repurchasing firms who face regulatory constraints. And the second one is liquidity where. Distribution of liquidity across different types of platforms is important. For example, we provide evidence, it's like dark pool liquidity matters for share repurchases. Why? So I don't want to repeat our result. I just want to talk about it in a above level. It's like, because dark pools matches orders based on price set by the exchange. This passive price determination dovetails nicely with the philosophy with 10b-18. And SEC even discussed the possibility to exempt dark pool from 10b-18 when dark pools match orders at the midpoint of bid and ask price. So policy implication, I want to talk about market structure and share purchases. The first one is like conflicts between old and new rules. So the rules in market structure now become more and more complex. For example, 10b-18, we find it can conflict with trade ad rule in an unintended way. So the regulators probably should examine whether proposed new regulations can contradict with existing regulations in an unintended way. And also there's more regulation versus the deregulation. For example, like high frequency trading and dark pools can be a response to existing regulations. And for share repurchases, I want to mention one point because this actually even enters in the presidential debate because over years, share repurchase increased dramatically. And there are some presidential candidates actually even go deeper, said, should we ban share repurchases? But there's limited economic analysis on why share repurchase increase over time. And our paper provides one interpretation for such result. So thank you.
Thanks a lot, Mao. So we have many questions in the Q&A, but now I've activated the raise hand function. So do raise your hand if you want to ask your question live. And we have one hand up, but before I take that, I just wanted to add a note about this liquidity for whom. Jerome Dugast has a new theory paper about this, that market depth is not, it's not only market quality, it's also a sign of long time to execution. You may want to check that out, Mao.
Yeah. Sure. I should. Yeah, so I should find that paper.
Marcus Carrera has a question.
Okay, hi Mao, it's a pleasure to hear you again, and thanks for the good presentation. And so Albert asked about the smoking gun, and there could be another smoking gun, which is, would you be able to find a firm that was in the middle of the repurchase program, and then the tick size change happened, and then they changed the rhythm of the program? It was a kind of a similar approach to Bjorn's paper on the diversity of high frequency traders, in which he looks at the tick size changes in the middle of the trading day and how high frequency traders change their behavior. So is there this kind of smoking gun in your database?
We didn't direct check that, but we have some indirect evidence. We find for the share repurchases, the major reduction happens in the first year. And the second year, because it's a 2-year pilot program, the second year, the reduction is slightly smaller. I think it's sort of partially address your question, but not exact. So I think your point is like a firm in the middle, right?
Yeah, so they are, let's say they have completed 50% of the program in, let's say, 2 months, but the other 50% take 4 months or something like that. Or whether you can actually look at the volume that they repurchase and say that, okay, they are in the middle of the program and they really changed the rhythm in the middle of the program because of the tick size change.
Oh, exactly. That's a great idea. I see your point. It's like holding the firm fundamental fixed, where the tick size pilot actually reduce the firm share repurchase compared to before, right?
Yes.
Before the tick size. That's a good question. Yeah. We'll check that. Yeah.
Okay. Yeah. Great. Thanks. And thank you again for the presentation.
Yeah.
Okay, next question.
Yeah, thank you, Bjorn. Great paper, Mao. I really enjoyed it. I have a quick question to follow up. You said there's a lot of flexibility to announce and not follow up with actual trades, right? So this is like lots of opportunity for agency problems and information asymmetry and higher order valuation considerations. So do you at all interact with some sort of valuation measures to see if firms are taking advantage, and does the tick size increase allows them to do that more easily? Right? That would be more fundamental to the regulatory questions and why there is so much opposition to repurchases.
Yeah. I think that's an interesting point. So we didn't go that far. I think that can be our next paper. So in this paper we just examined, because this is our first paper on this topic. Actually, it's my first paper on corporate finance and market microstructure. So we didn't go into big cross-sectional. I understand your point, because they're also, like Barclay has a paper, it's like a firms when they do repurchase, they actually becomes an informed trader of their share repurchase, of their stock. We didn't compare that, because in the tick size pilot, we just assume that it's like across like different samples. This part can be like partial out because of random experiment. But I think the next step, we should go deeper to ask more questions using this experiment. Thank you. Yeah.
Thanks.
Good. Everyone, if you have questions, please raise your hand. And at the moment, there is no hand up, so I'll take one of my questions. So I was thinking about whether this friction that you have identified here, if it's strong enough to motivate firms to change the tick size on their own, meaning by doing a reverse stock split, they can change their tick size and possibly overcome this friction. That's something you have thought about, and you think would be, do you think you would see more repurchases following reverse splits?
Actually, Bill, this is a perfect question, because not only I think about that, actually I have a model with a very strong prediction. What's the optimal tick size for a firm? With my other students, Sidali. Very intuitive. Each firm have an optimal price. So what is the optimal price? The optimal price actually balances two frictions, because if your price is too low, you are tick constrained. But if your price is too high, you are lot size constrained. That means 100 shares means a lot. So what's the optimal price? There's a surprising formula. We take that. A firm's optimal price, actually is easy to calculate, is if a firm has 2 tick bid-ask spread, they achieve their optimal price. The intuition is they should let the friction of tick constraint equal to the friction of lot constraint. So you have 2 discreteness, right? You have price discreteness. You also have like quantity discreteness. You try to, the marginal condition is like you should make the 2 friction correctly. And which firm actually did that? Berg Hashway here B. They have 2 tick spread. It's like they split and finally they have 2 tick spread. So my previous work is more on like tick constraint, but finally realized there's another lot constraint. And we find actually firm do split or reverse split. If they move to their optimal tick size, their share price can increase by 60 basis points because their liquidity increase. So split means like you should split, they're oversplit and they are undersplit. Oversplit means that you are low price stock, you reduce the price even lower. And they're also like undersplit. It's like, for example, some firms split, they still be a high price stock. So this is actually interesting. The beauty of market microstructure, you can actually come with a formula. So for formula is like a 2 tick spread is the optimal, leads to a 2 tick nominal spread leads to the optimal price of a firm. So yeah, we will post our paper on online, and we will also submit the paper to Market Structure Exchange. You don't need to take that paper, but we will submit to support you. Just
I'd be interested in seeing that. Thanks, Mao. Pankaj, did you have another question? Your hand is still up.
No, sorry, I forgot to bring it down.
Then we have Matt Pearson.
Hey, Mao. I have a question for you. Do you have any evidence, either anecdotal or systematic, that that rule 10b-18 is enforced by the SEC?
That's a good question. Actually, it's not our paper. It's a previous paper. Let me explain to you before many years ago and now. We talked to Philip McIntosh. So Philip McIntosh said, because now everything goes electronic now, he told me firms are extremely careful when they do buyback algorithms. They design their algorithm in such a way that they will not violate. So you see very limited enforcement. This is now. And then let's go back to about 17 years ago. There's a paper shows there are lots of violations, but they also debate whether that violation is real, because at that point, it's very hard to argue whether you violate or not. Because at the end of the day, you see some violation, but in real time, it's not a violation. But it goes back to the point. It's like most violation actually is in NASDAQ. So I show you the evidence before Manning rule. Actually, it's before Manning rule. If firm in a NASDAQ stocks, they try to do share repurchase, that's extremely hard. They may not intentionally violate 10b-18 because you are trading a dealer's market, so you might see some violations. But because of the data is very coarse, so we don't know whether it's because of data mislying with each other or there's some unintended violation. But go back to your question. Now we talk with like Philly McIntosh. He told me it's like basically guys, there's no violation because you use like a computer to share repurchases. So they just check that. Check that. So they will do self-compliance within themselves. So you see very few violations. But things can be slightly different many years ago. That's a good question.
Good. So we're approaching the end of the hour, and thanks for everyone who tuned in and who may need to leave by now. Mao has promised to stay on longer if there are many questions. Before you leave, note that next week we have Marius Soikan, who presents a paper about the ETF market. We look forward to that. There are no hands up at the moment, so take the opportunity to ask a question. I'll ask one more. There is one result in the paper, Mao, that it's about the difference between bid depths and ask depths. Or that if there is a large change in bid depths, that has a greater effect than if there is a large change in offer depths.
Yeah,
I understand the intuition that it's the bid depth that matters to these investors because they're always buying. But what I don't understand is why there would be a persistent difference between bid depth and offer depth when you're looking at such a long horizon, because the post period is 2 years or so. I find it hard to understand how these two groups of stocks can be so different, that that those with great bid depth increase are different from those with great offer depth increase. Where would that persistence come from?
Yeah, can I let my co-author Miles to address the question?
Sure.
Hi, Miles.
Hello, can you hear me?
Yes.
Yeah, I think in the short term, there's no much difference in the bid or ask spread, bid or ask depth because of the symmetry. But in the long term, when we partition the bid and ask depth, there is indeed differences. And when we partition the groups within the tick constrained stocks, because their bid-ask spread was binding, and we indeed find there's some kind of persistence in the 2-year period after the pilots.
Let me address your question slightly more directly. It's because when a firm do share repurchases, actually that's probably one way to identify firms who are actively doing share repurchases, because normally they should be balanced. But once a firm jumps into a share repurchase program, actually they increase a bid depth. Actually, that's also related to a published GFE paper showing it's like they try to do the in the reverse way. It's like so basically it's like a firm when they do share repurchases, they increase the liquidity. We believe their result is because think about it. In normal, it's like think about any market microstructure model. It's like it's symmetrical. But then you jump into a big trader. So I think actually you raise a great point. We probably identify a firm with active share repurchase program because there's a big guy joining the queue. It's not he's not trying to make the market, he's just trying to buy back shares. So I think there, yes, in a normal model, any like a inventory model like an information assumption model, we probably see symmetric. So, but now it's a big guy jump in. So I believe it's like our way is to identify big trade-off. But you are also correct in one dimension. It's like if you take without this pilot, the effect is much smaller. If we look at like decimalization, for example, that's a much noisy shock. Then it becomes much harder to identify this effect because there are originally some heterogeneity. So then if you participate over a longer time period with other background noise, you are not identifying that. So your intuition is absolutely correct. So we actually find almost much weaker result during decimalization. It's probably because it's much more noisy, and also it involves so much bigger firms. Lots of guys provide liquidity, and if you throw some shares to the market, it's been diluted. So short answer to your question, actually, we think our way of partitioning, we see abnormal bid depths. It tells you some big guys, they are not trying to make a market for bid-ask spread. They try to buy back shares. So then you see the asymmetry.
Very interesting. Thank you.
Yeah.
Thanks, Miles. Are there any more questions? I don't see any hands up at the moment.
So let me see.
Here is one. Xiaoyun Wang.
Yeah.
Please go ahead.
Hi. Yeah, I couldn't talk, so that's now I can talk. Because baby was sleeping.
Wow.
So if my understanding is correct, the friction coming from this rule 10b-18 is it because it makes the dollar amount of the payout risky with share repurchases, because by forcing the issuers to wait in queue, it causes extra execution risk. So if I can't execute this at this price, and the price moves up, I'll have to repurchase at a higher price, and that's a risky thing. So if that understanding is correct, then if firms announce share repurchasing in the form of like we are going to buy back a fixed dollar amount instead of we are going to purchase a fixed number of shares, would that resolve the friction? Thanks.
Oh, that's another great question. So I think, yes, I think we didn't directly address that, but there's some anecdotal evidence because firms can also do tender offer. So basically, they don't go to the market. So basically, it's like I go tender offer. I don't go open market share repurchase. I find a guy. It's like I ask you to offer shares. But I think your answer actually, but this kind of tender offer, the premium actually is huge. I mean, but that one is without execution risk. So I don't know whether the premium completely measures the execution risk, but that means like execution risk is non-trivial. Otherwise, so why firms should do like a tender offer at all without execution risk? So actually, you raise a great point. We should add that as intuition in the paper. So that's another measure of like so it's a measure. So our story is based on cost. I see your point. Your point is more based on risk. So I think the way to compare risk probably is another paper. Actually, it's like compare tender offer share repurchase with open market share repurchase. So in our paper, it's a compare of share repurchase relative dividend. But there's another paper like talking about execution risk. Yeah, that's a great point.
Thanks, Mao. So the next question is by Michael Goldstein.
Yeah.
Hey, Mao, that was excellent. I really enjoyed it.
Thank you.
I'm super intrigued, and I think everyone eventually should be, by the comment that while, and I've often thought this, if an HFT adds one or two more lines of code to put in an if statement, they will be too slow, which I always think is a danger. It means they don't have enough if statements. But I was curious if you, it may be too hard to calculate, but surely a proprietary firm could say, well, hey, we're just going to put the stuff in anyway. If it violates the term, we'll buy it. Otherwise, we'll allocate it to you. That would be a certain amount of, depending on, if it's a random walk, it probably would turn out to be net not that costly for the firm, but it could be a bit of a cost. But I was just curious if you have, and you probably don't, but if you have the ability to calculate kind of why isn't it that Citadel made that offer? Why don't they say like, look, you know, we can do this for you, where we'll eat the ones that are that don't comply, but we'll kind of do this more on a proprietary basis. The ones that comply we'll give to you, the ones that don't comply we'll take. And why would that be notably costly for them? I mean, it's uninformed order flow. They buy other kinds of.
Oh, good morning, Mike. This is a great question. And also, it's a good follow-up with Xiaojing's question. There's another way. Actually, there's a way they can do that. It's called accelerated share repurchases. So you can find an investment bank, say, and then the investment bank actually buy back all your shares. And then they take all your inventory. It's like basically they buy that all at once. Then they gradually try to try to swallow this big inventory. So that one also has a premium. So that also explains like the compliance and execution cost. It's not that trivial. But you're absolutely right. They can actually sign a contract with like Citadel or some kind of brokers, and then Citadel serve as a counterparty. The other thing is like also consistent with the observations. It's like we spent a long time to get to see a contract of share repurchases, and finally realize a big proportion of that is like if firms violate 10b-18, is whose responsibility? Actually, that's the main argument. Is like a firm, when they sign a contract, they actually defer that kind of like compliance risk. Some firms defer their compliance risk to their like broker. It's like, so they, if it violates a 10b-18, the broker is more subject to the risk of being sued. I think that's also consistent with your observation. Yeah.
Thank you very much.
Yeah. Do we have any more questions? Please raise your hand. I don't see any hands at the moment.
Yeah. So if you want to ask me a question privately, just email me. I will send you like a Zoom link. Oh, can I send a Zoom link? Where should I do if I want to send a link? Can I do that or no?
Let me see if I can.
Oh, I can see answered, type answered. So now I type an answer to Andrew Park's question, which is happened to be the last one. And there's a Zoom link. I will be there because I don't want to hold it beyond. It's your dinner time, right?
Right.
Okay. So if you're interested, I will be there to address any questions or further questions, or if you want to like give me any comments, advice, suggestions, that'd be great. But the main message, main takeaway from my presentation is like, think about the firms. It looks like a big trader in the market. It's like when they buy back shares or when they issue. I think that's probably one direction for our market microstructure research, is like the market microstructure of firms. Yeah.
Thank you very much, Mao.
Thank you.
Great presentation, and thank you everyone for coming, and see you next week.
Thank you, thank you all you guys.